Hello, everyone. This is Rob McDougall from Zhang Financial. Happy New Year. We're here today on Monday, January 6, 2025, with your weekly economic update. So last week was a short week, both trading and economic data-wise. We'll go through those numbers, take a look at the returns last week, and as we always do a preview of this week's economic data to come. So last week, again, a shortened week with New Year's. A few of the economic data points I hit were actually they were good. So last week, Monday, pending home sales came out. That was expected for the month of November to be up 0.7% month over month. Actually came in a positive 2.2% month over month. Initial jobless claims that came out on Thursday was expected to come in at 222,000 new initial claims. Came in lower, 211,000. So that was good. Friday, ISM manufacturing PMI. Not great, but still better than expected. The expectations for December was a 48.4. Again, 50 is the demarcation line between expansion and contraction. So 48.4 was the consensus. It came in at 49.3, so slightly better than expected. So with all that, those three data points, kind of expected the Atlanta Federal Reserve would have taken up their estimate for fourth quarter GDP growth. However, it went the other way. Now the Atlanta Federal Reserve expects fourth quarter GDP growth in the U.S. to be 2.4%. Just a week ago, it was at 2.6%. And maybe more importantly, a month ago, they thought it'd be about 3.4%. So expectations coming down somewhat significantly for the Atlanta Federal Reserve for fourth quarter GDP. In terms of inflation expectations, static from last week, flat. 2.34 is the expectation for average inflation over the next 10 years. In terms of the Fed funds rate, we do have a Fed meeting coming up 29th of January, and the expectation now is about 90% probability, no change, 10% probability of a 25 basis point cut. I'd go with the 90% at this point. So that was it in terms of economic data, an update from last week. So the markets last week, based on that data, again, just it was a short week without a lot of direction. So markets were down a little bit. U.S. equity, not really much to speak of. S&P 500 gave back about 0.5%, minus 0.45%. But for the full year, S&P 500 up a very strong 25.0%. So last week, with the S&P down about 0.5%, growth outperformed value, but small cap outperformed large cap. So small cap up 0.5% last week, large cap down 0.5%. We'll just do a full year recap just of the numbers for 2024. So S&P 500, I mentioned, up 25%, driven by the NASDAQ for the full year up 28.6%. Russell 2000 small cap up only 11.54%. So that's a strong year otherwise, but definitely the strength last year in the U.S., large cap and growth. We'll take a look at the rest of the world. So we'll just talk about last week. MSCI World ex-US, so developed markets ex-US down more than the S&P 500, down 0.7%. Emerging markets down about 0.9%, led by China giving back some of the gains that they had in the third and early fourth quarter. China down 2.8%. So I mentioned S&P 500 up 25% for the full year, vastly outperforming the rest of the world. So the rest of the developed markets ex-US only up 2% last year. Again, S&P up 25%. That is a massive outperformance by domestic stocks. Good for our portfolios as we overweight domestic. But emerging markets also lagging the S&P 500 very significantly. So S&P 500 up 25%, emerging markets up 5%. China did finish the year up 16.3%, but that's after a couple of tough years. So fixed income last week rallied a little bit. The 2-year yield was down 5 basis points, the 10-year down 3 basis points. So last week, the Bloomberg U.S. Aggregate Bond Index up about 20 basis points, and for the full year 2024 was up 1.25%. You would have had a very tough year had you been in long-term U.S. government bonds, 20-year duration plus. The U.S. long government index was down 6.4%. So for the full year, and this is a very impressive number, full year in terms of fixed income and rates and yields, the constant 2-year maturity throughout 2024 finished the year exactly where it started, 4.25%. However, the 10-year yield during that time dropped 70 basis points. So we went from an inverted yield curve to a yield curve that has a normal upward slope, and the 10-year currently is about 35 basis points higher than the 2-year. So let's switch to economic data that's coming out this week. Starting off with tomorrow, ISM services. Last week was manufacturing. This week is services. In December, the expectation is it's going to come in at 53. For the month of November, that was 52.1. And again, 50 is the cutoff line between expansion and contraction. Also on that day, also Tuesday, January 7th, the JOLTS job opening expectation is, I won't give you the number, it's a big number, but is expected to be slightly down, so even less new job openings than we had during the month of October. This is the number that will be reported is for November. Now, we don't often report on or mention ADP. We'll just mention today there's a lot of focus on the U.S. labor market. It's definitely decelerated. To what extent, we're not quite sure yet. But on Wednesday, we'll get the ADP employment change for the month of November. That was a positive 146,000 jobs. Again, this is an enterprise survey, not household. So it was up 146,000 for December, almost flat. Expected to be up 139,000 versus that 146 in November. On Thursday, this is a big number, a lot of focus. Initial jobless claims. The prior week was 211,000, which is low. It's expected to be up slightly this week, reported on Thursday at 217,000. Now, Friday is the big day in terms of economic data points. We have Nonfarm payroll, unemployment rate, average hourly earnings, and the Michigan consumer sentiment. Nonfarm payrolls, again, we're expecting deceleration in the labor markets. For the month of November, we added a surprisingly strong 227,000 jobs, which parenthetically, most of that was government. End of that. For the month of December, that's expected to be new jobs added, 160,000 non-farm payroll. The unemployment rate for December expected to be flat over November, 4.2%. Average hourly earnings expected to decelerate slightly. So the month of November, the average hourly earnings was up 0.4% month over month. For the month of December, consensus expected to be up plus 0.3%. Average hourly earnings year over year, that's expected also to be the same. That's coming in at 4.0%, same as we had in November. So lastly, in terms of economic data for this week, on Friday, we have the Michigan Consumer Sentiment Preliminary Index. For the month of November, that finished at 74.0, and we're expected to be roughly flat at 73.9 for the month of December. So that's it for the economic recap for this week. We thank you very much for your attendance. Again, Happy New Year's, and we'll look forward to seeing you next week. Thank you.